Hello and welcome to Markets Today. I'm Lata Venkatesh. With me is Surabhi Upadhyay. It was a choppy trading day and the markets ended finally lower, which means the April contract itself ended lower after much choppiness. The mid-caps put up some resilience, but the fact that the markets have ended just holding the 8,200 mark below the 200-day moving average indicates that more weakness is to come in the May contract. Hi, Surabhi.
Hi, Lata. What a month it's been for the markets. Let's see if May can be any better. Well, there's plenty to discuss over the next half an hour. Let's start with the headlines. The April series ends lower after a choppy session. The benchmark indices lose 0.7% in trade but close off the lows of the day. The Nifty shuts sharp below 8,200. FMCG, auto and metal stocks trade weak, but banks lend some support.
Broader markets, that is the mid-caps, fare better. The mid-cap index gains 0.3%. VRL Logistics sizzles in its trading debut, ending with a 43% gain over its issue price. RPG Life Sciences, Godrej Properties and Man Industries were the other stocks that ended higher, 4 to 10% on good results. Hexaware tanks 9% after earnings lag estimates.
Parliament discusses the finance bill. The government removes provision for creation of Public Debt Management Agency and transfer of control of the GSEC market to SEBI from the finance bill. The central bank's powers remain untouched for now.
Well, those were some of the headlines today. And now for a quick check on some of the big events, we have lined up the following big voices for you. The markets may currently be under pressure, but Samir Arora of Helios Capital still prefers India over other emerging economies, and he finds some support from Ramdev Agarwal of Motilal Oswal and S. Narain of ICICI Pru, who say this might just be the best time to enter the equities market. We'll get you all these voices. We will also get you Kiran Mazumdar-Shaw on the road ahead for her company after her fourth quarter numbers.
Okay, so lots of opinion coming your way, but let's start first with the action. The correction continues in the Dalal Street, and expiry day proved just about enough ammunition for the bears in trade today. Anuj Singhal is now here with the wrap of the day's trading highlights. Anuj, some recovery towards the end, but bears still being in control.
Indeed, well, this is a market which is not for the weak-hearted ones. It's a market which is volatile, and today was extremely volatile because it was expiry. In the series, the Nifty has moved 1,100 points, so clearly, traders were prepared for a bit of volatility. And that's what we got today. In the morning, the market was down quite a bit, first thing in the morning, but somehow the Nifty defended 8150 and moved on and actually closed up, somewhere around the 8200 mark. What was good for the market was that Bank Nifty and mid-caps continued to outperform, and sentiment got a bit of a lift with the kind of listing that we had for VRL. Let's talk about the stocks then. First, the Nifty gainers, because the market pulled back quite a bit in late trade. Stocks like Axis Bank, Reliance and BHEL were the top gainers. On the losing side, though, you had auto stocks. All of them were down today. Tata Motors, Maruti, M&M, Bajaj Auto, Hero MotoCorp, all were on losing side. Some other prominent Nifty losers included Idea, that was down about 3.5%. ACC as well down 3.5%, and Z was down about 2.5%. Among the heavyweights that pulled the market down, HDFC was down 2.5%, as is normally the case on expiry day. That's the most important stock to watch. ITC was down 2%, and TCS nearly 1%. On the gaining side, the stock of the day today was VRL. That had a stupendous listing, 43% premium to the issue price. Among the mid-cap losing stocks, KPIT Tech, well, that stock was down second day running, down 15%. Hexaware down 9% reacting to earnings, and Exide as well reacting to earnings, down 5.5%. And on the gaining side, you had some stocks like Indiabulls Real Estate, that was up 6%. UPL made a new lifetime high, that was up 5%. And Welspun Corp was up about 7%. So we've put an end to a volatile series, now an extended long weekend. And then, of course, you have the May series. You do get a sense that maybe there's one more downtick left in the market, but experts tell us that the market has now entered value zone, or at least buy zone, from a medium-term perspective.
Yeah, point taken. I'd rather go with you, Anuj, that with the 200-day moving average slipping and the markets distinctly showing a pattern of lower lows and lower highs, and FI still in sell mode, there perhaps are more attractive levels for buyers to come in. But all that and more next week. For now, let's get into a big market voice. Samir Arora, founder and fund manager at Helios Capital, says that the Indian equities are much better to outdo their peers in the long run. He has a word of caution, though, saying it would be wrong to expect to witness a replica of the rally that we witnessed in the last 12 months. Listen in.
Possible that for somebody who's Asian fund manager or emerging market fund manager, seeing the difference between the performance of India versus, say, China, even Russia, Brazil, even Asia, Japan, that they may try on the margin to allocate from here to there to try and catch that. In a big picture sense, anybody who moves around this fast is going to be a loser. And that's why most of these funds underperform. Because when last year India was doing well, they would be trying and bang money into India. And then suddenly, when China is doing well, they try, if they are trying, to reduce here and go there. In a big picture sense, for somebody who's coming completely afresh, India looks a much more sustainable rally than China. We have increased our net exposure a little bit by 5-7%. But my bigger picture thesis remains that some sectors are quite okay and you can say good, but some sectors are very bad in terms of a stock market expected performance. And therefore, we call this, as compared to 2014, which was a long only kind of environment, this is a perfect long short kind of an environment.
All right, shifting focus to the big earnings of the day. Biocon definitely beat street estimates with its fourth quarter earnings as the company's revenues grew more than 14% and they came in at 854 crore rupees. Profits saw a jump of more than 75% and they came in at 201 crores. That's thanks to an exceptional inflow on account of the sale of shares in its subsidiary Syngene, which is all, of course, set to get listed on the stock markets. Now, operating margins for the company took a bit of a hit. They came in at 23.65%. The company's CMD, Kiran Mazumdar-Shaw, believes that the performance is only going to improve now that capacity constraints have been addressed by the company.
Last fiscal, we had certain capacity constraints, which we have addressed through contract manufacturing arrangements. And we were also anticipating various regulatory approvals in emerging markets, and a very important announcement that we made earlier was the regulatory approval by the Mexican authorities for our insulin glargine, which now enables us to participate in large Mexican tenders for insulin and insulin analogs, which is really glargine. So I think overall we are very confident.
Okay, more results from the financial space. IDFC and Shriram Transport Finance also reported their fourth quarter numbers. Largely stable, it appears, on the face of it. Ekta joins in with more. Ekta.
Well, I'll start with IDFC, which delivered what was quite a good quarter in terms of a couple of parameters. So, for example, the profit was up 48% on a year-on-year basis to 382.21 crores versus an estimated 60-odd% in terms of a growth. Remember, the reason why the primary surge in the profit took place this time round was because of a base impact. In Q4 of FY15, IDFC reported provisions of around 480 crores, which resulted in the profits coming in at around 258 crores. And hence this base impact or this large surge in terms of profits was expected this quarter. Provisions were a positive because it was down 22.3% on a year-on-year basis, and sequentially, though it spiked up by around 145%, it was expected that the provisions could be elevated this quarter and could possibly range between 300 to 400 crores, and that's exactly what it came in at. For the gross NPAs, that is the asset quality performance, in fact, the gross NPA on an absolute basis was down 3%, and the gross NPA in terms of a ratio managed to stay sub 1% and in fact improve on a sequential basis, coming in at 0.65%. Moving to Shriram Transport Finance, the standalone numbers look quite stable this time round, and that is primarily what the stock reacts to. So the NII was up 18-odd% versus estimates of 1,068. It came in at 1,085 crores odd. The profit was up in single digits versus an estimated growth of over 10-odd% this quarter, which was a little bit of a dampener. That was because of provisions spiking up around 11-odd or 11.5-odd% on a year-on-year basis. What might worry the street would be the consolidated profit. Despite the NII growing 13% on a consolidated basis, the profit came in down 73% year-on-year to 84.23 crores. This is as provisions, which was the primary reason for that, which spiked up over 80% on a year-on-year basis. This is on the consolidated number.
Right, Ekta. Before we let you go, a quick check on Axis Bank as well. What a stunning rally in the market today. What have brokerages been saying?
Well, a couple of reasons why the market was still optimistic on Axis Bank post its numbers yesterday was possibly the restructuring as well as the total stressed asset guidance which was provided by the management post market hours. Now, the management did say that the restructuring pipeline stands at around 500 crores and overall the absolute level of stressed assets in FY16 should be lower than FY15. Separately, the bank also approved the raising of the FII limits to 74 versus 62% earlier. Also, the board approved taking on the ADR route going forward. Now, separately, there were also brokerages which were quite positive on Axis Bank post its numbers. So, for example, Barclays wrote on Axis Bank they remain overweight with a target price of 634 rupees. They said that it was an in-line Q4 results and the problem asset creation, though higher Q on Q, was well within the guided range. And the following offers reassurance for Barclays on Axis. One, which is the uptake in the rating profile of the corporate book, and secondly, management guidance that the stressed asset formation in FY16 will be lower than FY15. And going forward, lumpy large corporate exposures, however, remains a key risk. Credit Suisse also wrote on Axis Bank they maintained their outperform rating. They increased the EPS by 2% with a target price of 654 rupees. According to them, it was a strong Q4. And overall, to sum it up, they said that amid a difficult operating environment, the bank delivered a strong performance, increasing the divergence to peers.
All right, Ekta, thank you so much for that. Well, let's move on to all the policy news that we've got this evening. Presenting his final defense on the finance bill, the finance minister tweaks some tax provisions. The contentious MAT or minimum alternate tax goes only prospectively. Retrospectively, it continues to be effective on FIIs who are now fighting it out in court. However, the FM has said that MAT will not be applied to earnings from royalties and technology fees. More importantly, MAT will also not be applicable on the sale of units of REITs or real estate investment trusts. The FM has also lowered export duty on some grades of iron ore and raised the basic customs duty on natural rubber. All right, moving away from all the developments as far as the finance bill is concerned, the finance ministry has introduced some key amendments to the bill today. Topping that list is the move to remove all the 6 provisions dealing with the formation of independent debt management agency, which would take away the power of the central bank to manage the debt market in India. Additionally, provisions proposing that the market regulator take over the role of regulating the government securities market has also been dropped for now. Latana, this was doing the rounds right from the time the budget was initially presented. So does it mean that RBI keeps control completely for now?
At the moment, nothing changes for the Reserve Bank, but we should understand that there are 2 different provisions. One, the RBI as the merchant banker of the government, that power was to go over to a newly created body called the PDMA, the Public Management Agency. As well, its power to regulate the government securities market was to go over to SEBI. Both these came under what were called miscellaneous chapters of the finance bill. Now, the objection that would have been raised to this is not just that you are curbing Reserve Bank's powers without a proper debate, but you're doing it in the finance bill. Now, the finance bill is a money bill over which the Rajya Sabha has no power. It has to be passed by the Lok Sabha. Even if the Rajya Sabha rejects it, it becomes law. Now, the RBI Act is not a money bill. The PDMA is not a money bill. So the objection is it is improper to bury it in the finance bill. That is one reason why it has been removed. But the finance minister has reiterated that it will present it separately in the parliament.
But it will have to pass muster through the Rajya Sabha now.
It will have to pass muster through both houses, which is what puts a question mark on it, whether it will be done very soon, considering that there isn't so much of majority in Rajya Sabha. And if you have any political goodwill, you might as well use it for the land bill or for other important provisions. So chances are this could get postponed indefinitely.
Okay, well, lots of goodwill the government could really do with some of that. Time for a break now, but coming up, Sudarshan Sakhani joining in on a technical chat. We'll also get you some perspective from Ramdev Agarwal.